Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the US. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the US and GET in Canada. Find out more at glancepay.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to the show, Victor.
Jim, good to be with you. There's a lot happened in the month since we last talked.
A little bit of a correction. And people are wondering, is that the start of a big one? Or was it a little bump and things are just going to start climbing towards the sky again?
Nobody knows the future, right? Let's get that out of the way. And it would also depend on your time frame. I think that's going to be very important. But when we talked last month, I think I was pretty clear that I thought that the run-up that we'd had in the general American stock market, to put it in my grandmother's language, was an accident waiting to happen. I was watching for signs that the market was topping out. And I remember that Friday afternoon, the last Friday of the month of January, the market just sort of melted up to the upside, and I thought, okay, that looks like the last short, the last bear is just thrown in the towel, and that was it. At that time, I did buy some puts, some out-of-the-money puts. Now, I bought puts because for me, managing or limiting my risk exposure to the market is the most important thing in the world. Like, I need to protect my capital. So just because I thought the market was topping out doesn't mean it couldn't go a lot higher. So I bought puts. That was kind of a defensive strategy. The market did have a great break there the first 2 weeks or so of February. I was hoping to be able to add to my position. I got to tell you, I didn't. The break just happened so fast that I just couldn't bring myself to get some more on. And one of the old sayings, by the way, on the floors in Chicago was that when you're right, you can never have enough on. But then really, we had a bounce back the second 2 weeks of February. I think we came back about 75% of what we'd given away in the first 2 weeks, at least in terms of the Dow Jones. But the bounce back, to me, very narrow leadership. In other words, just like call it a handful of stocks were carrying the market higher. I'm of the bias that it's a bit of a dead cat bounce, and I got short yesterday. That'd be Thursday. No, where are we at? That was Tuesday, pardon me. When we rallied Monday, rallied Monday, made some new highs almost for the month, and then had a little bit of a breakdown. So I'm positioned short here. My rationale is, I think if you look at the chart for the last couple of years or more, the last kick or so from about Trump's election to the January highs, I think we had the Dow Jones rise 45% thereabouts. In other words, to me, it looked like the takeoff to the highs was just parabolic. So from a chart perspective, I'm thinking this market really is showing me signs that maybe it's topping. The other big issue is that the thing that I think underwrote the stock market rally over the past several years has been the easy monetary policy we've had from the global central banks. Call it in plain language, they've been printing money and pushing it out into the system, and the money had to go somewhere, went into stocks, as well as other things for sure. So certainly the Fed is backing away from the accommodative stance that they've had. The ECB, the European Central Bank, is talking about they'll start doing that later this year. And at the same time, we're going to see the governments, particularly in the United States, offering or needing more money to fund their programs. They're going to borrow more. Then I think that puts some upward pressure on interest rates, and that's one of the things that can pressure or at least take the edge off the rally here. And one last thing, and there could be a grocery list really, but one last thing, I noticed yesterday that consumer confidence in the United States came out, and it is the highest it's been since the .com era. To me, that's a contrary indicator. I'm comfortable to be short of the American stock market here. If the market starts to rally, I hope to get out before my short position turns into a loser.
We'll have more with Victor Adair right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Welcome back. We're speaking with Victor Adair. Victor, given your comments on the Fed, do you think interest rates will have to head higher?
I think that's the risk. I mean, interest rates certainly have been trending higher here. One of the key dates that I mark on my calendar was September the 8th of last year, just 4 months or so ago, when particularly the short-term interest rates in the United States started to push higher. And we've certainly seen the bond market trade lower in the past few months. So I think it is the risk that we go from a time when we had historically low interest rates. I mean, at the time of Brexit, I mean that's June or thereabouts of 2016. You had people. I saw people saying that we were at 5,000-year lows in interest rates. We certainly had something like $12 trillion worth of sovereign debt that was trading at negative yields. And as I mentioned earlier, we've got the Fed backing away, in other words, reducing the amount of money they put into the system, while at the same time, the federal government is going to be issuing more debt to fund their programs. It may be that we need higher interest rates to attract buyers. We've got the 10-year yield, Treasury yield here, creeping up near 3%. Now, one of the stories that says interest rates can't go higher is that the economy is so levered to low interest rates that if interest rates do rise, then the economy just grinds to a halt. Pardon me, that's poetic license. But the economy could certainly slow down as the debt service costs go higher. I think the risk is that interest rates go higher, and let's put that in the perspective of I think that maybe the credit bubble or the bond market bubble that we've had for the past few years, we had these ultra low interest rates, is the exception, and we'll maybe it's just been the biggest bubble ever. We've also got a new head at the Fed, Powell, and my thought is it is a new Fed. He talked yesterday with his congressional testimony indicating that, probably 3, if not 4 interest rate rises are on the horizon this year. But I think the thing that'll really be interesting will be whether or not he has your back. Like the thought has been since Greenspan. They call it the Greenspan put. If the market starts to look shaky, don't worry, he'll save you. Well, we'll see. Powell, we may get a test, and we may find out that Powell is not there with the white hat on to save everybody.
We'll have more with Victor Adair right after this.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, when we talked in January, you thought the U.S. dollar was going to go higher. I see the U.S. dollar index has risen a bit, and now it's at its best levels in 6 weeks. Do you see it going up higher from here?
Short answer is yes. The U.S. dollar hit a 14-year high just over a year ago and spent the last year trading down. The euro currency is up 20%, at least it was up 20% here at its highs this month, at around 125 from where it was a year ago. Yeah, I'm a U.S. dollar bull at the moment, and I'm happy to know that that's kind of a lonely position. You know, I hear people say, well, Trump wants the U.S. dollar to be lower, so, you know, like therefore it'll happen. Other people would be saying, you know, the country is such a mess with the deficits and so on that the rest of the world will not send capital to the United States to fund the programs that the government's going to spend money on. In the world of foreign exchange trading, let me tell you, the least ugly wins the beauty contest. Okay, everybody's got problems, and my really simple thesis is that the U.S. dollar is the place you go to when you get scared. Okay, if your capital, if fear is in the market, there's uncertainty, capital comes back to the center. New York is the center. Some country you couldn't find on a map, you know, someplace around the world, is the opposite. Capital will come from there back to the center. And I think, you know, after the complacency we had last year, I think we're going to get a little more of the shiver and shake variety of emotion in the market. So on that basis, I'm U.S. dollar friendly. How I am positioned right at the moment in the markets, I'm long the U.S. dollar by way of being short Canada, short euro, short gold, short crude oil, short the U.S. stock market, and temporarily here, I'm long of the bond market. I think we might get a little bit in the bond market because the stock market's got the jitters. But yes, I think the U.S. dollar goes higher. I see a massive bullish long position in the euro. And right now it's trading at about a 6-week low. I think we start to go a little lower from here. Some of the people that bought into that 20% rally in the euro are going to start to throw in the towel, and that could put a little more pressure to the downside. Some of the political fundamentals in Europe, we've got an election in Italy this coming Sunday. Germany still can't seem to put a government together. I think maybe some of the things that drew capital into Europe may reverse, and we'll see the euro go down. Now, the one currency that kind of stands out is the yen, and the yen seems to catch a safe haven bid if there's, you know, sort of worries or fear in the world, and the yen could rally while the euro goes down. So you could play this by putting out a cross trade where you bought the euro and sold the yen.
What about the Canadian dollar?
Canada, honestly, I think is the runt of the litter. Canada's down 4 cents, so more than 4 cents, I guess, for the 4%, I should say, for the month of February. I think it's been the weakest of what we call the G10 countries. I see the Australian dollar is down as well. Like the commodity currencies here under pressure. There's three things that effectively drive the value of the Canadian dollar. One is the relative strength or weakness of the U.S. dollar. The second is the interest rate premiums between Canada and the United States. And the third thing is generally just commodities. Now, there's always, you know, half a dozen other things besides that, but those are sort of the three feature things. So I think the U.S. dollar is strong against most currencies. The interest rate spread right now, you're giving up about 0.5% a year to be in Canada rather than the United States. That's on the 2-year Treasury spreads. And if the U.S. dollar is getting bid, commodities are probably under pressure as well. So, I'm negative Canada. I think the lows that we saw around 77.5 last fall are could easily get challenged. If we take those lows out, maybe we drift down to 75 cents.
Given that you think the U.S. dollar is going to go higher, what does that mean for gold?
Oh, well, it's not good news for gold. One of the, like I just said with Canada, there's three main things that contribute to the value. Gold, it's maybe even simpler. It is the relative strength or weakness of the U.S. dollar when you're looking at the U.S. dollar price of gold and real interest rates. And certainly gold is susceptible to what we call geopolitical crises and all that sort of thing. But let me just do this. From the middle of December to the middle of January, gold ran up about $120 an ounce. And I think that was entirely about the U.S. dollar being weak and fell to the lowest levels it had been in about 40 months or so. So, and during that same time, it was interesting that gold was so fixated on the weakness of the U.S. dollar, it ignored the fact that real interest rates were rising. So I think the risk here for gold is that if it does start to fall, like say moving along with the euro as a reflection of the U.S. dollar strength, the gold market may also then start to focus on where real rates are, and that could pull us down some more. So I think gold got some real headwinds here with the U.S. dollar going higher, and if that happens, then the real interest rates might come into play. I also noticed that as the stock market fell in early February, that the gold market came down as well. I think what was happening in early February was as much of, like, gold didn't catch a safe haven bid, is what I mean, like they'd say the Japanese yen did. I think what we were seeing was leverage being squeezed out of the market, and I think, the paper gold market is highly levered. And also, if people are getting margin calls, they sell their gold and meet their margin calls. So, I think in a risk world, or where the world is afraid, it's fearful, U.S. dollar goes up, and in this environment, gold goes down.
Crude oil was strong in January, reaching $66 a barrel, but it's fallen about 12%. What do you see ahead for crude prices? I've traded crude mostly from the short side since 2014. And therefore, like last summer, we took the price of crude from around $42 to up toward $60, and I wasn't participating. I wasn't on the long side, so my bias cost me some money there. I think what I call the supply-demand inventory picture is bearish for crude oil. The United States continues to produce more and more and more crude. I think just very short term here, in the next few weeks, as we come to the end of winter in the northern part of the world, we're going to see the demand for crude oil weaken, maybe 2 million barrels a day. I think there's more oil coming out of the market, all the time. Probably some cheating in OPEC. Anyway, I'm short of crude. I'm bearish there. I think a strong U.S. dollar puts some pressure on crude as well. But there has been some surprising strength in crude oil, and I've puzzled over this, and I wonder sometimes if there are not people out there, maybe they're on pension funds or whatever, people with longer-term time horizons, who are looking at how cheap commodities are relative to the stock market, and they're not reallocating some money away from, their winnings in the stock market and picking up some, what they think to be, cheap commodities. They're not looking to put the trade on today and take it off next week. This is longer-term positioning. And if in fact that's the case, I think the first commodity they look to buy is crude oil, and, maybe the next one is gold, and then on down the line from there. So, there's been some kind of surprising strength in crude. There is a massive speculative long position here. There has been for some time. I'm thinking if we get any more pressure on crude, and just today, we're down over $1.50, it's going to start to put some pressure on those people. We may see some throwing into the towel, and I think we could see the crude oil price drop below $58, $57 a barrel. Easy. Has Bitcoin and other cryptocurrencies been kind of the wild card this past year, sucking a lot of money away that normally would have gone into gold or stocks? Yeah,
maybe. I don't know. don't even pretend to follow the Bitcoin or cryptocurrency market. I don't. That's not a market I trade. When I told you what I'm doing here in the market, that's what I'm doing with my own money. And I also said earlier that I want to protect my capital. That's my first thing. I have all kinds of ideas. Lots of times I'm wrong. So I've been trading these markets I've been talking about for over 40 years. Why would I want to go and trade in the cryptocurrency market where I don't know a damn thing? So I really can't give you a fair answer to that question.
Well, some comments here. The EU Commission says crypto isn't currency. It's merely, it's like buying chips at a casino and you're just betting.
Yeah, I see those comments from time to time. I go through the news like everybody else. I'd have to say, I just tune it out. I'm paying attention to these major macro markets that I've traded for years, and that's where I think I've got some understanding, at least, of what kind of risk I'm taking. We saw the Bitcoin get listed on the Chicago Merc Exchange, was it in December, and shortly thereafter it had fallen in half. Well, wow, what a move! And by the way, I just for interest's sake, I watched the liquidity and the bid-offer spreads on that. It was bizarre. Just not a market I have any interest in trading.
Any final thoughts before we go?
Sorry for the rant, Jim.
Yeah, it's all right.
Yeah, final thoughts. I'd say this. Here's a couple, and I could go on for an hour, but I think we're going to have a much more volatile 2018 than we had in 17. That complacency that we had last year it's history. I think when people are looking at the markets, you really want to think in terms of keeping the time frame of your ideas or your analysis in sync with the time frame of your trading and vice versa. I think you really, I do this all the time. I really question my beliefs. I truly ask myself, why do I believe what I believe? And I want to challenge that. I look for people, particularly if I can find, good, bright people that are writing an opinion that's, opposite of what I believe. I want to think, where am I wrong? And here's something I discussed with my son, Drew, and, we talk every day, and Drew manages some money in a trading program that he has, and I put some money in that. And I'll say to him that there are people in the world that you don't even know exist. And those people are motivated to do things in the market, and you can't even imagine what that is or why that is. And certainly you can't imagine what impact they're going to have on the market. So what I mean to say is anything can happen out there. And if you're just prepared for things to maybe move a little bit up or a little bit down, you're probably going to get your world rocked. I think we're going to have a lot more volatility this year. And therefore, any beliefs you have about how things should be, not only it's meaningless, but it's dangerous to your financial health. Maybe the final line on that is, you got to play good defense, I think, is the thing you need to do.
Victor, thank you so much for chatting with us.
Jim, it's always a pleasure. The time goes by so fast. We just got started. Thanks, Jim.
My guest has been Victor Adair, co-founder of the Polar Futures Group. His website, polarfuturesgroup.com. You're listening to HowStreet.com radio. Questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.